Hello, and thank you for joining us here at PhillipCapital Market Watch. I'm Natalie, a research analyst with Phillip Securities Research, covering the REITs and property sector. Today, I'll be discussing about two big themes currently in the REIT space: mergers and the proposed raising of the leverage limits for REITs. Why the sudden uptick in merger activity, and will we see more of them? And how should investors view the proposed increase in the leverage limits? In 2019, there have been two proposed mergers in the REIT space. The OUE Commercial Trust and OUE Hospitality Trust mergers will bring together two trusts in different subsectors, creating a diversified REIT. While the mergers between Ascot Residence Trust and Ascendus Hospitality Trust will bring together two trusts within the hospitality sector with similar operations in overlapping geographies. Some of the benefits cited by the management of these REITs are the increased free float and trading liquidity, increased growth from stronger financial position, larger debt headroom due to the larger capital base, and the creation of a more diversified and resilient portfolio. We are paying close attention to REITs that have recently acquired a significant stake in another REIT or REIT manager. In May, ESR acquired an additional 51% stake in Sabana REIT's manager, bringing the interest in the REIT manager to 94%. ESR also owns 21.4% in Sabana. ESR is no stranger to the merger play, having completed their merger with Viva Industrial Trust in October 2018. So we may be seeing more action in this space. In other news, MAS released a consultation paper on the proposed raising of the leverage limit in July 2019. Increasing the leverage limit will give REITs the choice to use more debt in their capital structure. This is advantageous to the REIT when it comes to acquisitions and maximizing unit holder value. Firstly, it generally takes less time to obtain credit facilities than raise equity. Secondly, debt is a cheaper source of capital in comparison to equity, and when used in responsible amounts, will help to lower the REIT's cost of capital. Being able to secure funding quickly will allow REITs to react swiftly in deal negotiations and speeds up the conclusion of deals. Speed is important when REITs compete with private funds and other REITs that are not subjected to the leverage limits for assets. In addition, MAS also wanted to seek public feedback on whether the use of the interest coverage ratio will be an appropriate metric in determining the leverage limits for REITs. MAS is considering the option of allowing a REIT's leverage to exceed 45%, but not more than 50% if a REIT has a minimum ICR of 2.5 times. The interest coverage ratio measures how well a REIT can service interest obligations out of their recurring earnings. This is one possible metric, and it can be used to assess and differentiate between the financial strength of REITs. The idea of using another metric to determine and/or regulate the maximum gearings for respective REITs is to distinguish between REITs that have strong enough earnings to sustain a higher level of debt and have exhibited financial discipline over the years. Singapore-listed REITs have maintained at least a 5 percentage point buffer from the 45% leverage limits, with REITs keeping their leverage within 29 to 42%. The management of some REITs have also expressed that they will not be raising the targeted leverage, even if the leverage limits were to be raised. We note that even if REITs do choose to gear up in order to acquire, they will have plans to deleverage to a gearing level which they are more comfortable at, either through a dividend reinvestment plan or equity fundraising. Overall, the proposed raising of the leverage limits is positive for the REIT sector and will allow Singapore-listed REITs to be more competitive. That's all for PhillipCapital's Market Watch. Tell us what you think in the comments below. Remember to like and follow us on social media and subscribe to us on YouTube. Thanks for joining us, and see you again soon.